Private equity has a major impact on the American economy, both positive and negative. Here's a clear breakdown of how it works and what it does to businesses, jobs, communities, and markets. So, what is private equity? Private equity involves investment firms called PE firms that raise large amounts of money from wealthy individuals and institutions. They use this money to buy private companies or take public companies private, aiming to improve them and later sell them for a profit. Let's look at the positive impacts of private equity on America. First, business growth and turnaround. PE firms often inject capital into struggling or stagnant companies, helping them restructure, innovate, or expand. For example, a family-owned manufacturing firm lacking resources gets acquired, modernized, and scaled nationally. Second, job creation, sometimes. In successful cases, PE-backed companies expand operations, which can create new jobs in tech, healthcare, and other growth sectors. Third, economic efficiency. By cutting waste, automating processes, or restructuring leadership, PE firms aim to make companies more competitive and efficient. Fourth, high returns for pension funds. PE investments often fund pensions for teachers, firefighters, and government workers. Strong performance in private equity helps support retirement systems. But there are also negative impacts of private equity on America. First, job loss and cost cutting. To make companies more profitable, PE firms often lay off workers, reduce benefits, or outsource jobs. For example, after a PE buyout, a retail chain closes dozens of locations, leaving communities without jobs or services. Second, a short-term focus. Many firms focus on maximizing short-term gains, sometimes at the expense of long-term sustainability. Third, debt loading. PE firms often use a strategy called leveraged buyouts, borrowing huge amounts in the company's name to finance the purchase. If the business fails, it collapses under its own debt. Fourth, bankruptcies. Well-known companies like Toys R Us, Payless, and J.Crew were bought by PE firms, loaded with debt, and eventually went bankrupt, affecting thousands of workers. Fifth, reduced competition. PE firms sometimes buy multiple companies in the same sector, which can lead to higher prices for consumers, especially in housing, healthcare, and prison systems. Let's look at the impact by the numbers. Over 11 million Americans work at PE-owned companies. Private equity firms manage over $4 trillion in assets. In sectors like healthcare, housing, and education, PE ownership has raised concerns about costs and quality. So what's the bottom line? Private equity is a powerful financial force that can either revitalize or dismantle businesses. Stay tuned for more.